ever, stare at your savings balance and feel like it's just stuck in slow motion? You put money in, but it just sits there. Doesn't really do much.
Yeah.
If that sounds familiar, you're definitely who we're talking to today.
Yeah.
We all want our money to work a bit harder, right?
That's exactly right. And in today's world, just keeping your savings in one of those super low interest accounts, well, it can feel like you're missing out. There are smarter ways to manage your cash.
And that brings us perfectly to what we're diving deep into today. High yield savings accounts. HYSAs for short. Forget those like old school savings accounts maybe your parents had. We're talking about a tool that can genuinely boost how fast your savings grow.
Precisely. At its core, a high-yield savings account is still, a deposit account, safe place for your money. But the key difference, much, much higher interest rates compared to those traditional accounts.
How much higher are we talking?
Often we're seeing rates maybe 10, sometimes even 20 times the national average. It's significant.
Okay, let's make that real for a second. Right now, it's May 2025. And the average APY, that's the annual percentage yield for a standard savings account, is what? Hovering around 0.45%?
Yeah, about that. Pretty low.
Meanwhile, a high-yield savings account at the same time could easily be offering you 4.00%, maybe even more.
It's a huge leap.
Yeah, that's a pretty big jump.
It is, and that difference, it really adds up over time. So our goal with this deep dive today is to really explore how these accounts work, what the actual benefits are for you, what you need to watch out for the limitations, and, ultimately how to pick the right one for you.
Okay, you mentioned those much higher interest rates. To really get why HYSAs are powerful, maybe we should break down what interest rate actually means and this APY term we keep hearing.
Good idea. So the interest rate itself is just the stated percentage you earn on your deposits. Banks usually calculate this daily.
Okay.
But APY, the annual percentage yield, that's really the figure you want to focus on. Why? Because it factors in the magic of compounding.
Compounding. Earning interest on your interest.
Exactly. So you're earning interest not just on your initial deposit, but also on the interest you've already racked up. So even if a bank quotes, say, a 4% rate, if the interest compounds monthly, your actual yield, the APY, will be slightly higher. It reflects that interest earning more interest.
Okay, so going back to that $10,000 sample, if you've got that sitting in an account earning, let's say, 4.50% APY, you'd be looking at roughly $450 in interest over the year, give or take.
Yeah, about that.
But if that same 10 grand was just sitting in a traditional account earning, 0.45% APY?
Right.
You'd only see about $45.
Big difference.
Wow, that starts to feel really meaningful.
It truly does. And that really highlights the superpower here. Compound interest. Think of it like your earned interest getting its own job and earning its own interest.
Like a snowball rolling downhill.
Exactly. It's a snowball effect. It can really accelerate the growth of your savings, especially for goals that are maybe a few years away. And this is why HYSAs are such a fantastic tool for building up that emergency fund.
It's interesting. You see a lot of these high-yield accounts coming from banks that, well, they don't have branches everywhere. Mostly online places, newer fintech companies. Why is that? Why do they seem to offer the best rates?
Yeah, that's a really key point. It's largely down to their business model. Online-only banks and these fintechs, they just have much lower overhead costs compared to your traditional brick-and-mortar bank.
Right, no rent for fancy branches on every corner.
Precisely. They don't have the expense of maintaining all those physical locations, paying for staff in each one, utilities, all that. And they can pass those savings on to you, the customer, in the form of those higher interest rates, those higher APYs.
That makes a lot of sense. So who are some of the main players in this HYSA world right now? Like, as of May 2025, what kind of APYs are we seeing from the popular ones?
Sure. Well, some popular platforms you'll definitely come across include Ally Bank. They're currently offering around 4.35% APY. Then there's Marcus by Goldman Sachs. They're around 4.40%. So SoFi is another big one, often pushing slightly higher rates, maybe like 4.60% APY, though sometimes that might require you to set up direct deposit or something similar.
Sometimes there are conditions.
Sometimes, yeah. You also have Discover Bank around 4.30% and American Express High Yield Savings also in that, 4.35% ballpark.
Gotcha.
But it's really important to remember these figures are just a snapshot from May 2025. Interest rates definitely fluctuate.
All right, AP can change.
And the specific rates from different banks also depend on, well, their own business needs and just how competitive they want to be at that moment.
Okay, so we've got a pretty good handle on what HYSAs are, how they work generally.
Yeah.
But let's really dig into the core reasons why someone might choose one over, just sticking with their regular old savings account. What are the key advantages?
Well, the number one advantage, I'd say, is it's a surprisingly effortless way to just maximize your savings growth. You don't need to dive into the stock market or other, maybe riskier investments to earn a significantly better return on your cash.
So it's passive growth, basically.
Pretty much, yeah. Relatively passive. Your money just works harder for you.
That sounds absolutely perfect for something like an emergency fund. You want that money safe, easy to get to, right?
Exactly. And that's the second huge benefit. HYSAs are really ideal for building and holding that emergency fund. Most financial experts recommend having, 3 to 6 months worth of living expenses set aside.
Right, for those unexpected curveballs life throws at you.
Precisely. A HYSA lets you earn meaningful interest on that really crucial safety net while still keeping the funds liquid and accessible when you need them.
Okay, and what about safety? We hear about online banks. People might worry, are the deposits protected like in a regular bank?
Absolutely. That's a critical point. The vast majority of reputable HYSAs offered by banks are insured by the FDIC, the Federal Deposit Insurance Corporation.
Okay.
And if it's a credit union offering the high-yield account, it's insured by the NCUA National Credit Union Administration. Same difference, really. In both cases, your deposits are protected up to $250,000 per depositor per insured institution.
That's a solid safety net.
It provides a significant level of security. Oh, and one quick note on that $250,000 limit that's per institution. So if you happen to have accounts at, say, multiple banks owned by the same parent company, that coverage might be combined. It's always smart to just double-check the specific FDIC details for your bank.
Good tip. Another thing that seems appealing is the flexibility. You're not locking your money away for months or years like you do with a CD, a certificate of deposit.
That's benefit number 4, exactly. Unlike CDs, HYSAs generally don't tie your money up long term. You can typically access your funds whenever you need them, usually without facing penalties for pulling it out early.
But didn't there used to be limits on how many times you could withdraw?
Ah, yes. Federal Regulation D used to limit certain types of withdrawals and transfers to 6 per month. That regulation was actually suspended during the COVID-19 pandemic to give people more flexibility.
Oh, okay.
But even though the federal rule is suspended, many banks still have their own internal policies. They might limit certain transfers, maybe for operational reasons or to encourage saving. So it's still something to just be aware of in the account terms.
Right. Check the fine print. And it seems like HYSAs could be really useful for those, shorter term savings goals we all have, like saving for a big vacation or maybe a down payment on a car.
Precisely. That's benefit number 5. For those specific upcoming expenses where you need the money to be safe, you don't want market risk, but you still want it to grow a bit faster than zero, a HYSA is an excellent tool. Better return than standard savings, still safe, still accessible.
Okay, so they sound, pretty great on the surface, lots of advantages.
Mm-hmm.
But like any financial product, there've got to be things we need to consider, maybe some potential drawbacks.
Yes, absolutely. It's important to look at the whole picture. There are definitely a few key factors to keep in mind before you jump in.
What's the first one?
The first big one is that the interest rates on HYSAs are typically variable. They're not fixed.
Meaning they can go up or down.
Exactly. They can change based on broader economic conditions and especially based on monetary policy decisions made by the Federal Reserve, the Fed.
Right. And we saw a pretty clear example of rates going down not too long ago, didn't we?
We certainly did. Back in early 2020, when the pandemic hit and the economy shifted really fast, many HYSAs that had been offering maybe around 2.00% APY, well, those rates dropped pretty dramatically.
How low did they go?
In some cases, they fell below 1.00% by mid-2020. That was directly tied to the Fed making emergency cuts to interest rates to support the economy. So while rates are quite good now, in mid-2025, there's just no guarantee they'll stay this high forever.
That's a really important reminder. Okay, what else? What about getting your money out? We said it's accessible, but are there any catches there?
Well, that relates to the second potential challenge, those transaction limitations we touched on.
Even without Regulation D.
Right. Even with the federal rule suspended, you might find that your specific bank still has its own internal limits on how many withdrawals or certain types of transfers you can make from your HYSA each month. If you go over those limits, you could potentially face fees or, in extreme cases, they might even close the account.
Okay, so need to know the rules for your specific account. Right. Now, here's something I've wondered about. Even if you're getting a decent APY, like 4% or something, if the cost of everything, gas, groceries, rent is going up even faster, are you actually getting ahead?
That's a critical point. You're talking about inflation risk. And yes, that's challenge number 3. If the inflation rate, the rate at which prices are rising is higher than the APY you're earning.
Your money's losing buying power.
Exactly. Even though the number in your account is going up, the real purchasing power of those savings is actually shrinking over time. So for instance, if you're earning 4.00% APY, but inflation is running hot at 5.00%.
You're losing 1% in real terms.
Effectively, yes. Your money won't buy as much next year as it does today. We saw a really stark example of this back in the 1970s, actually. Inflation was really high, and people with money in low-interest savings accounts saw their buying power just erode significantly.
Wow. Okay. And finally, you mentioned earlier that not all HYSAs come with things like a debit card or ATM access. That could be inconvenient if you need cash really fast, right?
That's right. Challenge number 4, potentially limited access. The main purpose of a HYSA is saving, not daily spending. So many don't offer debit cards or ATM access if you need funds in a real emergency right now.
You can't just run to the cash machine.
Nope. You'll likely have to transfer the money electronically to a linked checking account first. And that transfer, well, it can sometimes take 1 to 3 business days to complete, so it's not instantaneous cash access.
Okay, definitely some important points to weigh. So let's say someone's listened to all this. They understand the pros and cons, and they're thinking, yeah, I want to open a high-yield savings account. What are the key steps they should take to make sure they pick the right one for them?
Great question. The first, absolutely crucial step is to compare APYs and do it regularly. Don't just grab the first one you see.
Use those online comparison tools.
Exactly. Use comparison websites, check bank sites directly, see how different banks stack up right now. And importantly, keep an eye out for promotional or teaser rates.
The ones that look amazing but don't last.
Right. They might offer a really high APY for the first few months, but then it drops significantly. Make sure you understand if the rate is introductory or ongoing.
Good point. And it's not just about the highest APY number, is it? What else?
Definitely not. Tip number 2 is watch out for fees. While most HYSAs really promote being fee-free, you absolutely have to double-check the details.
Like what kind of fees?
Look for things like minimum balance requirements. Do you need to keep a certain amount in there to avoid a fee or get the best rate? Are there monthly maintenance fees? And, as we discussed, check for any fees related to excessive withdrawals or transfers.
Okay, makes sense. And since these are often online only, the whole digital experience, the website, the app, that must be pretty important too, right?
Hugely important. That's tip number 3. Evaluate the mobile and online experience. Is the app easy to use? Is the website intuitive? How responsive is their customer service if you need help?
And security, presumably.
Oh, absolutely critical. Look for strong security features things like multi-factor authentication, encryption to keep your money and your information safe. A smooth, secure digital experience is vital.
And if getting money moved reasonably quickly is important, even if it's just transferring it to your main checking account.
Then tip number 4 is to check those transfer times. If you anticipate needing to move money between your HYSA and your checking account fairly often, or you want it to happen relatively quickly when you do.
Some are faster than others.
Yes, some banks process those electronic transfers faster than others. Look into their typical timelines for ACH transfers to linked external accounts.
Okay. And finally, it sounds like maybe doing a bit of homework on the bank or the platform itself is a good idea, beyond just the numbers.
Definitely. That's tip 5. Look at account reviews and user ratings. Don't base your decision only on the APY. See what other customers are saying.
What are their experiences like?
Yeah, what's their customer service really like? Did people run into unexpected problems? Were there any hidden catches in the terms? Reading reviews can give you valuable insights. And as we mentioned, established names like Ally, Marcus, American Express, they generally have a pretty solid reputation for service in this space.
Right. Yeah, the world of finance, it never stands still, does it? What are some of the trends or maybe future developments you're seeing in this whole high-yield savings area?
Yeah, it's definitely evolving. One big trend is just the continued innovation coming from fintech companies and these newer neobanks.
What are they doing differently?
Well, they're increasingly blurring the lines between traditional checking and savings. You see more hybrid accounts offering high-yield features combined with checking-like capabilities. We're also seeing way more automation, AI-powered tools popping up to help you set and hit savings goals, plus tighter integration with budgeting apps.
Any examples?
Sure, companies like Chime, Varo, SoFi, they're really active in this space, trying to build these more integrated experiences.
Interesting. And what about the interest rates themselves? We said they're pretty good right now in mid-2025. What's the general feeling about where they might go?
Well, as we sit here now, we're in a period where the Federal Reserve has kept interest rates relatively high. That's been part of their strategy to manage inflation.
And that's good for savers? For HYSA rates?
Generally, yes. It's led to these more attractive APYs we've been seeing. The current thinking is that we'll likely see rates stay around these more elevated levels, at least for the near future. But again,
Subject to change.
always subject to change based on the economy and what the Fed decides to do next.
It also feels like companies are trying to get us to do everything with them. Banking, investing, maybe even insurance, all in one place.
Absolutely. That's another clear trend, this move towards integrated financial ecosystems. Companies are bundling savings accounts with investing platforms, insurance products, financial planning tools, creating these super apps.
The idea being you manage your whole financial life from one dashboard.
That's the goal, yeah. To give you a more holistic view and theoretically more control over everything in one spot.
And finally, technology seems to be getting better at helping us save almost without us noticing.
It really is. That's another exciting development. The rise of automation and AI specifically for saving. Think about apps like Capital or Digit.
How do they work?
They use algorithms, basically. They look at your spending habits, and based on rules you set, they automatically figure out small amounts of money they can safely move from your checking into your high-yield savings account.
So saving happens in the background.
Pretty much, yeah. It makes the whole process almost effortless for people who find it hard to actively put money aside.
Okay, to really drive home the impact HYSA can have, maybe you could share a couple of quick examples, like how it might make a real difference for someone.
Sure, certainly. Let's imagine Sana. She's a teacher, and she was really focused on saving up for a down payment on her first house.
Okay.
She diligently saved $30,000 over, say, 18 months. She put it in a HYSA that was earning 4.50% APY during that time.
So what did that earn her?
By the end of those 18 months, just from the interest, she'd earned over $1,000.
Wow, an extra $1,000 just from choosing the right account.
Exactly. And that extra money, that could realistically cover a good chunk of her closing costs, or maybe help furnish the place. It's a tangible benefit.
Yeah, definitely. How about another one?
Okay, consider Imran. He's a freelance graphic designer, so his income can be a bit variable. Having a solid emergency fund is really important for him.
Makes sense.
He kept $15,000, which for him was about 6 months of living expenses in a high-yield savings account. Over 1 year, let's say, he earned $675 just in interest.
Not bad for money that's just sitting there for safety.
Right. And he decided, okay, I'll use that interest money to upgrade my home office setup. New monitor, better chair, whatever. Something that actually helps his work. So the interest provided a direct, practical benefit.
Those are great examples. They really show how that extra interest isn't just numbers on a screen. It can translate into real-world advantages. Okay, before we wrap this up, are there any common misunderstandings or myths about HYSAs that we should probably clear up?
Yeah, a few definitely come to mind pretty often. One big one you hear is, well, why not just invest that money in the stock market instead? Get higher returns.
Right. Why settle for 4% when the market might do 10%?
It's a fair question, but it misses the point of why you use a HYSA. Investing, especially in stocks, yes, it can offer higher potential returns over the long haul, but it also comes with way more risk and volatility. Your investment could lose value, especially in the short term.
Not what you want for your emergency fund.
Exactly. HYSAs are about safety and stability. They're ideal for short to medium-term goals like that down payment, and especially for that emergency fund you need to know will be there. They're really designed to be your main engine for long-term wealth building. That's what investing is for. They serve different purposes.
Okay, that distinction is important. What else? I know I've heard some people feel a bit nervous about online-only banks. Are they really as safe as the big bank down the street?
That's another very common misconception. The reality is, reputable online banks and credit unions that offer these high-yield savings accounts, they have the exact same FDIC or NCUA insurance protection as your local physical bank branch.
So that $250,000 protection applies just the same?
Just the same. Your deposits are protected up to those limits. And honestly, because their focus is technology, sometimes online banks have incredibly robust security measures and can even offer really efficient customer service through digital channels. The online part doesn't make them less safe, assuming they're properly insured.
Good to know. And one last thing people might notice, The rates on these accounts seem to change more often than maybe they expect. Why do they fluctuate like that?
Yeah, that can be confusing. It's tied directly back to the Federal Reserve and its benchmark interest rate, often called the federal funds rate.
The rate banks lend to each other.
Kind of, yeah. The Fed adjusts this rate up or down as one of its main tools to manage the whole economy, trying to control inflation, encourage growth, that sort of thing.
And HYSA rates follow that.
Generally, yes. When the Fed raises its target rate, banks usually have more room to offer higher rates on savings, so HYSA APYs tend to go up. When the Fed cuts its rate, banks typically lower the rates they offer, and HYSAs follow suit. It's all part of the bigger economic picture.
Okay, so bringing this all together then, what's the main takeaway? What's the key message you'd want our listeners to leave with about high-yield savings accounts?
I think the core message is pretty simple. HYSAs offer a really smart, very secure, and actually relatively easy way to make your savings grow faster without taking on significant investment risk.
So a fundamental tool.
Absolutely. They might not be the flashiest thing in finance, but they are a crucial building block for a strong, healthy financial foundation.
And for anyone listening right now who maybe has a decent chunk of cash just sitting in a traditional savings account, earning next to nothing, well, it really sounds like they could be missing out, losing ground even.
They likely are, especially when you factor in inflation. If your savings are parked in one of those accounts earning, surfing token something percent.
You're losing buying power every year.
Pretty much. HYSA lets your money grow at a much more competitive rate, helps it keep pace better, while still giving you that essential safety and access when you need it.
So the action item for listeners seems pretty clear then. Take a look. Compare the options out there. And seriously, think about opening a high-yield savings account to take a bit more control of your financial future.
Absolutely. It's a straightforward step, usually pretty easy to do online, and it can make a genuine difference to your savings goals over time.
Okay. And on that note, maybe here's a final thought for you, the listener, to mull over after we finish. How could you actively connect a high-yield savings account with the way you already budget or track your money? Could integrating it further optimize your whole savings strategy and maybe help you reach your goals even faster?
Ooh, that's a fantastic question to chew on. And thinking about that naturally leads to other interesting areas too, doesn't it? Like, okay, how does a HYSA stack up against maybe a money market account or a CD? Are there specific HYSAs that work better if you only have a small amount to start with, or if you deposit money irregularly? And how can some of those automation tools we talked about really supercharge your saving habits when you pair them with a HYSA? Definitely some valuable things to explore as you keep building your financial knowledge.